Hello everyone, welcome to Demand Supply Trading Practical Session number 33 for the year 2024. Myself, Srijit Kakkar, and today is Sunday, 1st of September 2024. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, before we move ahead, I would also like to add that we started with a WhatsApp channel where we keep updating you regarding the schedule of these sessions. Plus, if you have any videos coming up or if you have any offers coming up. So, if you wish to join this channel, you can scan the QR code which is available on your screen. Otherwise, you'll also be able to find the direct link in the description. By clicking on that link, you'll be able to join that WhatsApp channel. So today's session will be practical application of demand supply methodology. So our demand supply course used to be a paid course, but we made it absolutely free for you people some time ago. And if you have still not gone through the course, you will be able to find the playlist in the description, which is the complete course content. It is available in two languages, English as well as in Hindi. So wherever you're comfortable with, you can go through that language. You can learn the complete methodology. Now, when you go through the playlist, which is the course content, you basically learn the methodology theoretically, right? What demand supply is, how it has to be applied, what are the nuances of the methodology. So you learn all those things theoretically. But unless and until we apply to some practical examples, we do not get a very good understanding of it. So it's more like you do require hand holding, and that is what these practical sessions are all about. So in these practical sessions, I take some examples, and to those examples, we apply the complete methodology, which helps you understand how to plan trades using demand supply methodology in a very mechanical and rule based way. And the beauty of this approach is that when we are doing the analysis, we are looking at these practical examples. We are not looking at something which has already happened in the past. We are planning for the future. And that is the beauty, that it's not something which has already happened. We are reviewing it. It's all about planning in advance, and eventually when those trades they get triggered, then seeing how those trades they play out, right? So nothing can be more transparent than this, that we are planning in advance, and eventually when they get triggered, we review those trades, and that helps you build the confidence in the methodology. Now, before we start with today's example, we do have one example which was getting carried forward for us, and we will be starting with our example, and which was getting carried forward, and then we'll continue with our example for today's session. So just give me a second, let me bring up the one which was getting carried forward for us. So it's just going to take me a few seconds, just bear with me. Okay, so this was the one. Perfect. So this was session number 30 for the year 2024. We did the session on the 4th of August, and this was a type 1 trade for us. Like I said, we did the analysis on 4th, and on 5th, which is this particular day, we got the fill on this. It gave us a move which was about 3 is to 1, but we were looking at a target which was about 5 is to 1, even if you're looking at a tested zone. So we talked about that the only opportunity as of now we have is to make it as a break-even trade once it crossed our 1 is to 1 mark, but eventually you can see it came back to our break-even point, and that is where we would have been out of the trade. So we will be closing this trade as a break-even trade now. You can see again, after coming back into the zone, we again got some bounces. We are again getting closer to the zone. So it has been tested multiple number of times, but yes, as far as the outcome is concerned, we will consider it as a break-even trade, because after 1 is to 1 move, we would have only got the opportunity to to make it as a break-even trade, and we did not get the opportunity to trail onto it. Again, whatever I'm talking about is based on the rule book which I've given you, but yes, different people can have a different approach. Like some people might want to book some partial profits at 2 is to 1, right? Some people might want to wait for either the target to get hit or the stop loss to get hit. So again, depending upon your personality styles, the outcome can differ, but I am going with what I have been sharing with you as far as the trade plan is concerned, which is a very conservative trade plan, wherein at 1 is to 1 we make it as a break-even trade. We did not get the opportunity to trail onto it, so we'll be calling it as a break-even trade. All right, so that takes care of the one which was getting carried forward for us. Now let's look into the example which we have for today. Just give me a few seconds. Let me bring up the one which is for today. All right. Just give me a second. Perfect. So let's get started with our analysis for today. So whenever we talk about trading, always say trading has to be a very mechanical and rule-based process. And why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you have not yet watched that video, then the link is available in the description. Do ensure you watch that video, understand why it is very, very important that we need to be mechanical and rule-based. Plus, what is the process we should be following? I've also explained that process in that video. Eventually, everyone will have to go through that process. So the sooner you start, the better it is going to be for you. But do ensure you watch that video and follow that process. Now, since we need to be mechanical and rule based, if you have just started learning trading, or you're learning demand supply methodology or any other methodology, it's not very easy to create a trade plan on day one, because unless and until you have a good enough experience of that strategy, you cannot convert it into a rule based system. So this is where these two documents, they come handy for you. So I have shared two documents. One is called as the trade plan steps. You can also call it as the walkthrough or the flow chart. It basically guides us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules, and those rules are available in the rule book. I have said this many, many times. The rule book that I've shared with you is a conservative approach. With time, with experience, if you want to make some modifications to it, those modifications can definitely be done. But at least you do have a starting point using which you can start planning your trades in a very mechanical and rule-based way. And eventually, as you progress, based on your experience, you can definitely make modifications to it. So what is our step number one whenever we start planning our trade? Our step one is we need to define our trade purpose. And what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose as our step number one? And the reason for that is, whenever we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We start by first defining our trade purpose, because logically, the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. That is why trade purpose is the very first step we do, so that we can choose time frames which are in sync with that particular style of trading. So what I've done is I have divided these trades into four different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, example, like we are doing analysis for the NSE, which is the National Stock Exchange, the Indian Stock Exchange, one of the Indian stock exchanges, what I should have said. So these markets are not open for 24 hours. So I'm pretty sure all of you would have experienced, whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is, if you get a gap in your favor, you might get profit which is bigger than what you were expecting. But if you get a gap against you, you can also lose more than what you were willing to lose on that particular trade. So this is why when you're trading markets which are overnight markets, and they are not 24-hour markets, you have that inherited gap risk involved. And that is why my recommendation to all of you would be that, even though daily income implies a trade which can last for a day or few days, initially our hourlies and dailies will be strictly intraday trades, because we don't want to keep that position overnight and take that unnecessary overnight gap risk. Now, for weekly monthlies, anyhow, we are not anticipating to get the exit the same day, so here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that we cannot have a gap against us for weekly monthlies. It can still happen, but since we are leaning against some bigger time frames, the probability definitely reduces. But as you start having more and more experience, if you want to include daily incomes into overnight trades, that can also be done with time and experience. It's just that initially, as a risk management rule, we would like to avoid that. So your step number one is, we need to define our trade purpose. And let's assume I opted that I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 on the rule book, we start with the topic that is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. What are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now minded, the table that I've given on page number 31 is specifically for the Indian NSE market, because this market is open for about 6 hours and 15 minutes for a very short duration during the day. But if you're trading markets which are open for longer durations, then you can refer to page number 32. So this table can be used for commodities, forex, cryptocurrencies. If you're trading some international markets which are open for longer durations, yes, you can look into this table. But for NSE, we'll refer to this table. Now, since I opted, I want to plan monthly income trades. So from this table, I got to know my time frames as a monthly income trader will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Daily will be the lower time frame. That is where we get our SCTS from. SCTS stands for stop loss entry target and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, I have the clarity to what time frames I'm using, plus what analysis I'll be doing on each and every time frame. So my challenge number 1 is taken care. Now, the next challenge is, yes, I do know my time frames, but again, if you talk about the NSE exchange, we have over 2000 companies which are listed on the NSE exchange. So humanly not possible that I sit and analyze 2000 companies every day. So what we need now is a process for selecting some scripts, right? From a very big list, we need to select a smaller list, because if I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 plus companies every day, it's not an easy task. So how do we do this? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then these computer programs, they identify that out of these n number of symbols, which symbols are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for us. Now, very important, no matter what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell those symbols, right? Be that stocks, be that commodities, be that forex, be that cryptos, right? Whatever it might be, you can never blindly buy or sell, because the job of the scanner is not to tell you what you need to buy or sell. The job of the scanner is, I can't analyze such a huge list, help me get a small list. Now, once you have that small list, you will have to analyze each and every symbol individually and check which one matches with your trade plan. Whatever matches with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. Now, a few examples of these scanner screeners. Example 1, if you go to my website, you will see under the free tab, I have created some scanners for you, which are based on some moving averages, and they can help you in shortlisting symbols using these moving averages. Second example, on my YouTube channel, if you search for scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. That example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll also be able to find a video on top-down analysis, which can help you in shortlisting symbols. So these are 3-4 different examples, but you're not restricted only to these 3-4 different scanners, screeners. Let's look at few examples. So like I was saying, that once you go to our website, under the free tab, you have stock screener option. Because I opted, I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting 3 symbols for me. So like I already said, Just because the long scan is giving me these three symbols does not mean I can blindly buy these three, right? So the job of the scanner was from a big list, it is helping me get a small list. And can you see for the long scan, it only gave me a list of three symbols. And if I look at the short scan, it is not shortlisting anything for me. So you can see that out of 2000 plus symbols, I just need to analyze now these three symbols. If any of these three they match with my trade plan, I have an opportunity. If nothing matches with my trade plan, I don't have any opportunity. Now, many times what can happen is your list can be a very small list, like you can see today, or maybe at times not even a single result is getting generated because none of these conditions are matching with those 2000 plus symbols which are available on NSE. Now, or even otherwise, if you wish that my list should always be a little bigger list, because the more number of symbols you're analyzing, higher is the probability you might find something which is in sync with your trade plan versus when your list is a very small list. So what you can see is that in this scanner, I have given 5 different conditions. So to have a little bigger list, you can disable the third condition. You can run the scan again, and I'll do the same thing here. I'll disable the third one and run the scan again. So initially you saw that it was only giving me a list of about 3 symbols, but after disabling this option, I'm getting a list of about 94. So I got 94 from here. And if I look at the short scan, you can see it is giving me a list of about 18. So we have around 112 symbols to look into. So you can see that using different filters, you can make your, or different conditions, you can make your list a little bigger, you can make your list a little smaller. If you feel, just as an example, that 94 is too many, I want to further filter it out, I can select, okay, I don't want from the cash segment, I only want the ones which get traded in futures. I run the scan again, and now you can see out of, instead of 94, it is giving me only a list of 17 symbols. So yes, you can make this list bigger, you can make this list smaller by using different scanners, use different screeners, using different filters. Whatever you feel is the best fit for you, is a good enough sample size for you, or a list of symbols for you, that is what you can do. And plus, this is not the only scanner which is available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available. Some are based on fundamental analysis. Then you have your top loved, you have based on candlestick patterns. Then you have your range breakouts, bullish scan, bearish scan. Then you have your intraday bearish, intraday bullish, crossovers. So you have a number of scanner screeners available to you. And this is example of one website. If you do a Google search, you'll be able to find a number of websites, a number of scanner screeners, whatever you feel is the best fit for you. Using that, you can get your list. Now, in this example, you saw that we got a list of about 112 symbols. Now, when you start analyzing them, few more challenges which you will realize eventually. So challenge number one is, what you'll realize is that when you're analyzing a big enough list, majority of the symbols on that list, they don't have a quality demand area or a supply area on the lower time frame. And the reason for that is because all these 150,000 plus scanners that I showed you, none of them are based on demand supply zone. So just because something is getting shortlisted does not guarantee that they'll have a quality area on the lower time frame. So that is why when you analyze such a big list, you might find few where you might have quality areas, but the majority might not have quality areas, which is where you'll be wasting a lot of time analyzing such symbols where nothing actionable is available to you. Now, a few symbols might have quality demand supply areas. Those areas might also be far away from the current market price, which is where you'll have a longer waiting period before the prices are back into the zone. And during that waiting period, what might happen is whatever price action develops, it might even disqualify the trade setup for you by the time it is back into your zone. So these are some of the challenges you will face when your scanners are based on either conventional technical analysis or fundamental analysis. And to overcome these challenges, I've also created two custom built scanners which are purely based on demand supplies. Once again, they are not call giving or tip giving services. They are also scanners. The only difference is these scanners are purely based on demand supply zones. Now, just to quickly understand them, now if you want to have more information about them, yes, we do have the link to the walkthrough videos in the description. You can go through those walkthrough videos to understand them better. But just to give you an overview how they basically work, if we start with the first one, which is alerts. Now, how does alerts basically work? So what alerts basically do is that as soon as you have a formation of demand zone or a supply zone during the live market, right? So it is constantly monitoring the market during the market hours, and as soon as you have a formation of a zone, it notifies you. Now, what I'm showing you is a screenshot from our demo channel. You can see we have a demo channel for NSE, we have a demo channel for Forex, we have a demo channel for MCX, where for about 30 minutes during the day we give you alerts. So you can see on NSE on the 30th of August at 11:15 on Page India, we had a formation of rally-based rally on the 60 minutes time frame. That's the proximal value, that's the distal value. So as soon as the leg out completes, right, we have the formation of the zone, you immediately get notification, and that is what alerts they do. They keep notifying you during the live market as and when the zones are getting formed. Again, I'll add, these are not call giving or tip giving services. Just because we have a demand zone formation does not mean I can blindly buy at this demand. So it is only telling you that on this particular symbol, on this time frame, we have a formation of a zone. If that zone matches with your trade plan, yes, it might be an opportunity for you. If it doesn't match with your trade plan, it has no meaning for you. So similarly, you can see you have alert for the daily time frame, for the 5 minutes time frame, for the 15 minutes time frame. So as and when these zones are getting formed real time, you keep getting these notifications, and that is what alerts is all about. The second scanner we have is based on not the formation of the zone, it is based on the arrival to the zone. So when the current candle starts getting closer to a demand area or a supply area, it shortlists for you. So as an example, here you can see I have applied the demand supply screener, and in this screener you can see I've given a list of about 40 symbols, and then I have given my settings that whenever the proximity is 1%, which means whenever the current candle is within 1% to a demand area or a supply area, you shortlist for me. So now you can see out of these 40 symbols, it is telling me if you are interested in long trades, then we only have 2 symbols which are closer to demand zones, and if you are interested in a short trade, then we only have 1 symbol which is closer to supply zone. So you can see out of 40, now I don't have to go through all 40 symbols because I know none of them are closer to demand or supply other than these 3. So example, if I go to Tata Motors, you will see on Tata Motors, the current candle will be closer to a demand area. That is why it is highlighted for me. So here you can see we have a drop-based rally structure. Current candle is pretty close to it, and that is why it got shortlisted for me. Similarly, if I go to ICICI Bank, I will again be close to a demand area. That is why it is getting shortlisted for us. So let's just give it a few seconds. You can see we have this rally-based rally pretty close to it. That is why it got shortlisted for us. And if I go to LNT, you'll see I'll be closer to a supply area. So that is where you have your supply zone, a rally-based drop, and that is why it got shortlisted for us. So that's the difference between the two, that the alerts, they notify you as and when the zones are getting formed during that particular day, right? But with the screener, the zone could have formed today, the zone could have formed a week ago, a month ago, an year ago, 10 years ago. As long as the current candle is within that proximity range, it will get shortlisted for you. And again, once you create this, you can also use it on different time frames. Now currently I was on the daily time frame, so it was giving me results based on daily. If I change it to weekly, now you will see I'll get my results based on the weekly. And if you have a paid account on TradingView, you can apply the screener multiple times on multiple chart layouts, and you can have as big of a list you wish to shortlist symbols for you. So that's the difference between the two. Alerts are based on the formation of the zone during the live market. Screener is based on prices coming back to the zone, whether that zone was formed on the current day or X number of days or weeks or months or years ago. All right, so wherever you feel is the, again, right fit, use that process to get a list for you. Again, I'll add, none of these are call giving or tip giving services. These are only scanner screeners which help you get a small list. Process can also be as simple as I don't use any of these scanner screeners. Because I want a small list, I will only be analyzing my Nifty 50 stocks, right? So it's your choice how you want to get that small list, but you will have to use one or the other process to have a small list for you. It can be as simple as, okay, this is my favorite list of symbols, and these are the only symbols which I want to analyze, right? So choice is yours, how you want to get that small list. But definitely, the more your process is in sync with demand supply zones, the probability of finding a tradable opportunity definitely increases, right? So that's the advantage which you get. But at the end of the day, like I said, it's your choice. These are not mandatory tools. These are optional tools. They help you in different ways. If you want to use them, good enough. If you don't want to use them, you can use whatever process you wish to. So let's assume whatever method I applied, I got a list of symbols, and the very first one in that list was ABC. So what am I supposed to do now? The next thing is I need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my time frames were monthly, weekly, daily, and 60. And out of these 4 different time frames, daily was my lower time frame. So I'll go to the daily chart, and on the daily chart, we need to identify a zone. By zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So let's go back to the symbol where we are analyzing. Now, currently you can see I have the demand supply zone indicator applied, which is where I don't have to identify the zones. The indicator does it automatically for me, plots the zone for me. So the process becomes much more mechanically easier and faster. But remember, demand supply is based on price action. Price action. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Only 2 things. It can either move up or move down. It cannot do anything else. But when price is moving in a very narrow range, we call it as the period of pause, or you can also call it as the basing. Now, when we start learning demand supply methodology, initially our eyes are not trained to identify these structures. So that is the time to mechanically train our eyes. We start with a concept which is called as boring exciting candles, because you will see that majority of the zones can be identified based on boring exciting technique. Again, I'm saying majority of the zones. I'm not saying all of the zones. So that is why it is a good starting point to start training your eyes. But once your eyes are trained to identify these structures, then you will be paying less attention to boring exciting. You'll be paying more attention to what is price action telling me. Now, just as a very simple example, if I talk about what is price action telling me on this chart, if I zoom out a little bit, you can see below the current market price, we have a really nice strong move to the upside. Before that, we had this brief period of pause, and before that, you can see prices were moving up. So if I talk about what is price action showing me, we moved up, we paused for a while, we again continued with this move to the upside, and that is what we call as a rally-based rally structure. And that is what also the indicator is marking for us. Again, minded, the demand supply zone indicator is a very advanced indicator. It is not based on boring exciting technique. It identifies the zone for us based on price action versus boring exciting. But yes, you do have boring exciting indicator available to you, which is an absolutely free indicator. You can use it for free forever. Similarly, the explosive move indicator is also a free indicator. You can use it for free forever. However, the demand supply zone indicator is subscription based. But we do have the demo version available for it. So if you go to the indicator section on TradingView, search for demo demand supply zone indicator, you'll be able to find one which is listed by my name, Surjit Kakkar. You can use that demo indicator if you want to try it out. But yes, our step 3 was to identify a zone, which the indicator is doing for us. So what I'll do is I'll draw the zone, and let's mark it as demand. So this was our step number 3, that we need to identify a zone on the chart. The indicator made that process easier for us, and we do have a rally-based rally structure available to us. So that takes care of our step number 3, which is identify zone. Do we have a zone available? Answer is yes, we do have a zone available. Now, once you have identified the zone on the chart, does not mean you can blindly trade it, and that is the biggest mistake demand supply traders they do initially. They find any demand area on the chart, blindly start buying. They find any supply area on the chart, blindly start selling, which is incorrect. You can never blindly buy at any demand area or sell at any supply area. Once the demand or the supply zone has been identified, the next step is you need to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify based on the booster scoring. So the very first thing we'll check is that the zone we have identified, can it be a case of level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. And that is why, if that shift is required, that is the very first condition we look into. Now, how do we verify this? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone is dividing into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here, that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level. But if we don't have a coinciding level, it can never be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? Now, as a monthly income trader, our intermediate time frame is weekly, and on the weekly you can see we do have this drop based rally structure available to us. So let's draw this zone, and this time I'll mark it with a different color so that we can differentiate between the two. So the one marked in pink is your intermediate time frame zone, the one marked in green is your lower time frame zone. So the concept which I was talking about, that if you have an intermediate time frame zone and your lower time frame zone is inside of it, we call it as a coinciding level. So we definitely have a coinciding level. So now the question is that, do we just have a coinciding level, or do we also have a case of level on top of level? Now what you need to remember is that in case of level on top of level, it is not mandatory that the other zones might be quality zones. So currently on the lower time frame, the indicator is only identifying quality zones for us, right? But if I want to see all the structures of demand and supply, I can change my indicator settings to all demand supply zone structures. So once I check mark this, now you will see it will identify all demand supply structures. And now you can see that we do have multiple zones inside of my intermediate time frame zone. So this is your intermediate time frame zone, and inside of this, this was one zone which we already talked about, and this is where you have another zone which we have inside of it. So we definitely have multiple areas. So that's your first lower time frame zone, and that's your second lower time frame zone, and both of them are inside this intermediate time frame zone, which makes it as a case of level on top of level. So what we should be doing in case of level on top of level, in case of level on top of level, to have the maximum probability stacked in our favor, we should be going for the lower zone, and that is the shift we will make. So can you see, even though we started with the zone above, but being a case of level on top of level, we shifted to the lower zone, and that is why level on top of level is the very first criteria we look into, because if it is a case of level on top of level, we will have to make that shift. And now that I've made that shift, I can disable it so that it only shows me quality areas, but we do have a zone here which is a drop based rally. So my uh, very first condition, level on top of level, was definitely applicable. Based on that, whatever modifications were required, I made those modifications. This zone is not because of a gap, therefore gap rules will not apply. Pivot non-authentic, definitely applicable, because whenever we talk about a drop-based rally or a rally-based drop, in this case you can see it's a drop-based rally structure, we always consider it to be a pivot or a non-authentic zone. Now the question is, yes, it is a case of pivot or a non-authentic zone, but do I have to apply the rules of pivot and non-authenticity to it? The answer is no, and the reason is available in the rule book. So here you can see in the rule book I've given you that in case of level on top of level, there is no need to apply pivot or non-authentic rules, because being a case of level on top of level, by default adds that extra probability we are looking for, right? So since it by default adds that probability, I can skip the rule for pivot and non-authenticity. Similarly, I can skip the rule for unstable equilibrium as well, because it is a case of level on top of level. Now, if you want to be extra conservative, right, a very conservative trader, and you still want to apply the rules of unstable equilibrium, that is your call. But generally, in case of level on top of level, I overlook this one as well, because level on top of level is by default adding that probability. So after applying the applicable rules, is the zone qualified for us? The answer is yes, because none of these conditions disqualified the area for us. If any of these conditions would have disqualified, yes, we then had no choice but to move on to the next symbol. But since none of these conditions are disqualifying the zone is qualified for us. And now the next step we'll do is the booster scoring for this. So coming back to the booster scoring, the very first one is freshness. You already saw that the lower zone was already tested by the upper zone. You can see that is why it is not marked in green, it is marked in cyan color, because a tested zone is always green. Sorry, a fresh zone is always green. A tested zone, the indicator shows with the cyan color. So the zone is already tested for us. And since the zone is tested, it is a very shallow touch. I'll give it a score of 1.5. Now talking about the strength, here you can see the lower zone, we just have a leg out, we don't even have a follow through. So we don't have a good strength, definitely not an explosive move, gets a score of 0. Time at the zone, we only have one candle in the basing, gets a score of 2. Reward to risk ratio will be taking as an assumption, because nobody knows how the arrival will be, and the reward to risk ratio can change based on the arrival. So now the very first question comes probably to your mind is that why are we trading a low quality zone? And the answer again comes from the rule book. So you can see in the rule book, if you go to page number 107, I have given you certain characteristics of cases of level on top of level. Now, minded, these characteristics will not be applicable every time, right? At times, these characteristics might be applicable, maybe one of them, maybe two of them, maybe all three of them. And at times, maybe none of them might be applicable. So do not assume that if it is a case of level on top of level, it's mandatory that these characteristics have to be applicable. They might apply, they might not apply. But what are the characteristics which you will see? The very first one is, in case of demand, the lower zone might be tested by the upper zone, and that is exactly what we saw, due to which we gave it a score of 1.5 being a tested area. Next is in case of demand, the lower zone might have lesser strength versus the upper zone, which we can also see here. The lower zone does not show any strength. The upper zone shows us amazing strength. That is also one of the characteristic. But based on the lower zone not showing us very good strength, we gave it a score of 0. And the last one is that in case of demand, the lower zone might have more number of candles versus the upper zone. Now, this one is not applicable in this case, but at times what can happen is, like here you can see the upper zone has about 3 candles in the basing. The lower one might have maybe 5, 6, 7, maybe 8, maybe even 9, right? So the number of candles can even be much more versus the number of candles we have in the upper zone, though this one is not applicable in this case. So what you need to remember now is that level on top of level basically implies that you are trading the intermediate time frame zone by fine tuning it on the lower time frame. So what I'm basically doing here is, if I go to my intermediate time frame, you can see we have this drop based rally structure. If I wanted to trade this drop based rally structure, this is what I would have done. If I wanted to go wick to wick method, that is where the proximal line would be. Body to wick method, this is where the proximal line would be. But now, since I could see that this zone was getting converted into multiple zones on the lower time frame, I was further able to fine tune my zone, and I was able to push my proximal line a little deeper. So now you can see I'm basically trading this same area by having a little deeper entry, because the same zone gets converted into two different areas on the lower time frame. So that is what we are doing. We are basically trading the intermediate time frame zone by fine tuning it on the lower time frame. And that is why if you see these characteristics, you can ignore those characteristics, and the zone can be rated based on the intermediate time frame. Now, very important, whenever you are rating the zone on from the intermediate time frame, the boosters which already have the highest score, you don't have to touch them. The ones which do not have the highest score, will check, can we upgrade the scoring for these. So if you talk about freshness, you can see on this particular time frame, now this zone is a fresh zone. After leaving the zone, prices have never been back. So this can be upgraded to a score of 3, because now the zone is a fresh area on the intermediate time frame. Similarly, if you talk about the strength, now for a second, if I remove automatic settings, you can see with the quality zone settings, this is an explosive move, which means I can even upgrade my strength to a score of 2. So something which was a score of 6.5 and made it as a low quality zone, by understanding the characteristics of cases of level on top of level, we were able to upgrade it to the highest score, which is a score of 10 out of 10, obviously with the assumption of reward to risk ratio. Now, the next thing is, what is the location? If you go to the monthly time frame, you will see that we are planning it middle of the curve. So middle of the curve is not a location which is helping us as far as the location is concerned, not even against us. So we can give it a score of 0. Talking about the trend, you can see that the indicator is telling us we are in a sideways trend. So again, this trend is also not supporting us, gets a score of 0. Though this will fall under the category of an aggressive trade. We'll talk about it as we move ahead. Next is move from the zone. We need minimum 4:1 move, which has already happened. So if I draw it again from here till here and coming back, so you can see we have 1:1, 2:1, 3:1, 4:1, probably a little over 5:1 move. So gets a score of 2. It is definitely a case of level on top of level. It was also coinciding. And talking about trap, I can also give it a score of 1. And the reason for that is, if I take a horizontal line wherever the proximal is and start pushing it up, you can see almost this area in the past has been acting like resistance. Here also has been acting like resistance. Then you have resistance. Now it is acting like support. So we have a pretty clean area of support resistance. Now, people who believe in support resistance being an area of support, they would be buying somewhere around here with their stop losses placed below, and those stop losses will be sell orders. And similarly, if you have a breakout, then people who believe in breakout trading will also start selling. So we understand by the time we come into this demand area, a lot of selling will be coming into the market, and these people are making two novice mistakes. Mistake number 1, they are selling after a decline in price, which means they are selling at a cheaper price. And mistake number 2, selling in an area where in the past chart has proven to us demand exceeded supply, which could be the only reason for prices to move up. So yes, it can work like a trap. Therefore, we'll give it a score of 1 for it. And if you look at the overall scoring, we have a high quality, high probability trade setup, and high quality, high probability can be traded as a type 1 trade. So yes, we have a type 1 setup for us. Now, no matter how high the quality or the probability, like I always say, any trade can be a stopped out trade. So you need to be ready for the worst case scenario, for which you'll do your proper position size calculation. Now, whenever the prices are back, you'll have to re-verify, because markets are not static. They are dynamic. Conditions are changing almost every other second. So before getting into a trade, we'll have to re-verify, does it still qualify based on my trade plan? If the answer is yes, you place your order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1 we make it as a break even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. And that is how we plan trade in a very mechanical and rule based way. Now, I also said this is also an aggressive trade. Let's also understand the reason behind that. So if you go to the action grid, you can see the action grid basically tells us that on your lower time frame, if you have a demand area, and that demand area is located at the equilibrium location based on your curve analysis, which is done on the higher time frame, and your trend is sideways, then in a sideways trend, you should not be taking any action. Now, again, I have said this almost every other session, that this is a very conservative trade plan. So what we are trying to do in a conservative trade plan is we are trying to get uh, probability stacked in our favor from at least 2 time frames out of these 3. So in this case, what is happening is the intermediate time frame is not supporting us because we are not in sync with the trend. Plus the higher time frame is also not supporting us because we are not closer to the higher time frame demand area. So that is why we are saying we should not be taking any action, because we don't have support of 2 different time frames. But can you see, if I talk about being in an uptrend, at least we have support of 1 time frame, even though the other time frame is not against me, right? So if it is not with me, at least it is not against me. So again, this is a very conservative approach. But as you start having more and more experience, some people might say, okay, at least sideways is still not against me. I'm okay by planning a long position here. And similarly, I'm okay planning a short position here. So can you see, that's a small modification to your trade plan based on your experience, right? Based on your personality style. So again, as of now, the trade plan tells us we should not be taking any action. The booster scoring tells us, yes, if you want, you can do it as a type 1 trade. And that is why I'll call it as an aggressive trade, because an aggressive trade implies a trade which does not match with my trade plan, but the booster scoring is allowing me to take that trade, right? That is why we'll qualify it as an aggressive trade. So it is an aggressive trade. It can be looked into if you have good reward to risk ratio when the prices are coming back. Nothing wrong with that. It's just that the default trade plan which I've given you is a very conservative approach. All right, so that takes care of today's example. And now let's see what do we have in the chat box. But before we look into the questions, queries we have in the chat box, let me add, if you people are liking these sessions and these sessions are helping you, do hit the thumbs up button. And if you are on some trading groups, or if you have any friends or family members who are into trading, you can also share the link to these videos, link to my course content, so that they can also go through it. It might help them. So let's see what do we have in the chat box. So the very first question is from Akshmeet, and the question is, today can you please explain pivot and authentic zone with some example and in more details? Sure. So let's understand what do we mean by pivot and authentic. Though I will not be going to the chart to find an example, because that might be a little bit time consuming, but I'll definitely help you understand what do we mean by pivot and non-authentic zones. See, the first thing is, when we are talking about pivot and non-authentic, it's a term which is interchangeable, right? Whether you call it as a pivot, whether you call it as a non-authentic zone, it's exactly the same thing. But let's understand what we are talking about here. So when we talk about, I'm taking example of demand, but the same thing is applicable to supply as well. Now, if we talk about demand areas, we basically have 2 structures. We have a rally-based rally and we have a drop-based rally, right? These are the 2 structures we talk about. So now let's assume that we have a rally-based rally structure. Let me mark this. Let's also mark this, right? And now the prices, they come back to the zone, right? And then they maybe spend some time in this demand, and again, you get a reaction from here. So can you see, a reaction to a rally-based rally is basically a drop-based rally. Similarly, if you have a drop-based rally structure, the same thing happens. Prices, they come here, maybe spend some time, then again start moving up. So irrespective whether it is a rally-based rally or a drop-based rally, if the prices, they come back to the zone and they react from it, uh, a structure that is formed is also a structure of a demand area, even though this is a test of the zone, even though this is a test of the zone. So that is why whenever we see a drop based rally or a rally based drop in case of supply, by default we consider them that they might be an authentic zone, because this zone was formed as a test of a previous zone, this zone was formed as a test of a previous zone, or maybe this zone was also formed as a test of a previous zone. So this is why by default we always consider these reversal patterns. Why? Because the leg-ins and the leg-outs are always reversed, right? So we always consider these reversal patterns by default as pivot or non-authentic zones, because they can be test of previous zones. That is why we call them as non-authentic. And the reason we also call them as pivot is because if you talk about conventional technical analysis, right? Conventional technical analysis is all about these pivot highs, pivot lows. That is how we use these pivot points to understand where is support, where is resistance, right? So everyone is using these pivot points in conventional technical analysis. That is why when we have such structures, we need to add a little extra probability, because of which I've given you some rules that if we see these structures, we'll add a little extra probability by applying some additional rules. And that is what pivot and non-authentic is all about, right? So I hope it helps you understand that since they can be a test of a previous zone, if not a test of a previous zone, it is still something which is highly used in conventional technical analysis. We need to be a little bit more careful with these areas. All right, so let's see what we have. Please activate HVIV indicator. So Rajendra, what you need to do is just send an email to info@surjitkakkar.com with your TradingView user ID, and it will get activated for you, because again, HVIV indicator is an absolutely free indicator. So just send an email with your TradingView username. In about 24 hours, it will get activated for you. I guess the bell notification is not working since I'm not getting any email from YouTube for the upcoming live session. Should I scan a WhatsApp QR code to be notified in the future? See again, if you are joining the WhatsApp channel, it will not give you notification on Telegram, sorry, on YouTube. But if you have the notification activated, ideally it should notify you. If it is not notifying you, I don't know what could be the reason for it. But yes, if you are joining that channel, because we keep updating when the session is happening, at least you'll be notified on your WhatsApp that we have a session coming up on this day at this time, wherein if you want to just set a reminder for you, you can do that, so that you don't miss the session. Request you to take Nasdaq. Please see again, Mahendra. Like I said, the problem here is anyhow I'm not disclosing the name of the symbol, right? So it doesn't matter whether I'm looking at the NSE or any other markets. But the reason I'm taking examples from NSE is because that is what I trade. So I'm not doing any extra work. Wherever I'm shortlisting for myself, I just pick something out of it, and that is something which is much more easier and comfortable for me as well, right? But again, since the name of the symbol is anyhow not shared, you can consider it to be any symbol from Nasdaq if you wish to, right? So that is how it is. Can you discuss some pointers about scaling out of positions, so you don't have to worry about break even when your original target has not been hit? See again, if I talk about myself, I generally don't scale out, and the reason for that is, let's say if it goes to 2:1, and let's say I book my 50% profit. Now what happens is I'm only left with 50%. So even if it goes to, let's say, 8:1, now I only get about 4:1 because I'm already out 50% of the position. So I generally don't prefer to do that. I prefer to trail onto it unless and until it hits my target or hits my stop loss. Generally, I don't even make it break even at 1:1. So when I plan my trades, it's either my stop loss or my target. Or if I get the opportunity to trail onto it, then I start trailing onto it. I generally don't make it a break even trade. Now, just to show you, answer this question, why I generally don't do that, let me do this, is because if I just take some examples which I have been sharing with you, right? So you can see this was our session number 1 for 23. We haven't got the fill on this one as of now. So this one we can move ahead. So now you can see this was session number 12. As of now, you can see if this is my 4:1, 5:1, 6:1, maybe we are somewhere around 15:1 or 16:1. Now, if I would have booked, let's say 50% at a 2:1, even after being a 15:1, I only get about 7:1. So that is why to me it doesn't make sense. Why? Because uh, being in that trade with the complete quantity will give me a much higher reward to risk ratio versus if I'm just left with, let's say, half the quantity or 25% of the quantity or 75% of the quantity. So that's your session 12. Here's another example, session 13. You can see probably we are at around maybe 10:1 as of today. Uh, Session 18, we haven't got the fill. Session 20, we came very close, but we haven't got the fill on this as well as of now. You can see session 21, we are probably trading maybe 20:1. So again, the same issue. If I would have done scaling out, Even if I'm at 20 is to 1, I only get about 10 is to 1 plus, out of 2 is to 1, something which I've already taken is just 1, right? Because I'm booking 50%. So a 20 is to 1 now converts into an 11 is to 1. So that is why to me it doesn't make sense. If you have confidence in your analysis, you know that these trades can give you bigger moves. Why not to stick with the complete position and have bigger reward to risk ratios? Now you can see this one also, which is session number 26. Currently, we are probably at maybe 8 is to 1 or 9 is to 1, right? That's your session number 27. Again, trading close to about 3 is to 1. 28 we didn't get the fill. 29 again we came pretty close, didn't get the fill. 30th we just reviewed, right? And today we were doing okay. So you can see 31st as well, we got a move which was about 4 is to 1, currently trading about 2 is to 1. And today's session is 33, which we are still looking into. So I just wanted to show you a few examples. This is the challenge with scaling out, that if you scale out, uh, yes, you can be in bigger moves, but since your position has been maybe halved, or maybe you're already taken 25% or 50% or 75%, those bigger reward to risk ratios you'll start missing, right? That is going to be the challenge. Or in another word, scaling out at a portion of your position, say 50% break even, and then trading stop loss. See, yes, that is what I was talking about, but I showed you what will be the downside of it. The downside will be that when you get those big moves, you don't get those big reward to risk ratios because you're already out of the position. And that is where those big RRs, they go for a toss, right? So that is going to be the challenge. Do you use for forex or some other platform? See, I actually don't trade forex, and the reason for that is that I am from India, and in India trading cross currencies is not legal. It is we only have few pairs which are available on the NSE exchange which can be traded, but again they again cannot be traded 24 hours. So since it is a very small array of symbols which are available, I generally don't try to trade them. Plus, they are not even very liquid enough. I'm more into trading purely the NSE stocks, right? That is what I do. Okay, I found a level on HIT which has level on top of level when going to intermediate time frame. I found there are 3 more levels in the lower time frame, level on top of level, because all 4 of them. So I choose the lowest one. Absolutely. So again, see, when I talk about level on top of level does not mean that it is only getting converted into 2 zones. I always say multiple zones. It can be 3, it can be 4, it can be even at times 5. 5 I've rarely seen. Up to 4 I've seen many times. So let's say if you're looking at a demand area, you have 4 demand areas in the lower time frame, which are all part of one of the intermediate time frame zone. Then you go for the lowest one, right? That is what we are trying to do in case of level on top of level, and in case of supply, the highest one. Do you continue to trade thrice a week class in the morning and the evening? Do you continue to take? Okay, so what you're talking about, the paid classes which I used to take before, where we were taking 3 sessions in a week. No, now can you see I'm doing exactly the same thing? I've stopped taking paid sessions. Now all my sessions are absolutely free. Everyone can learn the complete methodology, so no paid classes. Whatever was taught in the paid classes is now getting taught as free sessions. Okay, is there in a situation where one of the condition while evaluating the zone will disqualify the zone? Can you explain, please? Yes, there can be conditions where one of these conditions can disqualify. Now, if I just go back to what are the conditions we are looking for. Now, level on top of level cannot disqualify, because even if it is not a case of level on top of level, does not disqualify. Now, let's assume if you are a trader who's a very conservative trader and you say, okay, if I'm trading, I'm always trading a case of level on top of level, then it disqualifies for you. Otherwise, it is not mandatory that it has to be a case of level on top of level. Now, when we are looking at gaps, and let's say the gap proves to be a novice gap, it gets disqualified. If it is a pivot or a non-authentic structure, which is either a drop-based rally or a rally-based drop, and does not qualify based on the rules of pivot and non-authenticity, it again gets disqualified. Similarly, if it is an unstable equilibrium structure and does not qualify based on the rules of unstable equilibrium, it will again get disqualified, right? So there can be cases where it might get disqualified, but generally what happens is when I'm picking examples for you, I'm always picking examples which will qualify, right? That is the reason I'm sharing those examples with you. Now, whatever has been disqualified anyhow, I'm not bringing it as an example for these sessions. So that is why at times it might be a little bit challenging to show you examples which are not qualified. But yes, what I'll do is I'll keep it at the back of my mind that whenever we are doing some analysis, if there are some zones which are a little above or a little below uh, other than the one we are looking into, and if they get disqualified, I can probably show you as an example. Okay, that is an excellent example to see the application of the rules in the rule book. Hope you can continue to show other examples, and yeah, I'll definitely try to do that. And that is what my objective is, that I always try to pick different kind of examples where whatever I've given you in the rule book can be applied to it, and can you see that practical application always gives a better understanding of what that rule is all about. So it's not that this is the very first time we would have taken such a case. We would have also done similar examples in the past as well. But what happens is, let's say if you got to know about my channel when we were already at session 22, right? But I took that example in session 18, and you have not gone through the previous sessions, so that is where you're not able to see those examples. But I do try my best to take different examples almost every other session. So yes, like I said, once you are gone through about maybe 50, 60, 70 sessions, probably every kind of examples would have been taken care of. All right, a very good example, level on top of level, very helpful. Okay, happy to know that it's helping you. I try to find HIT on symbol Nifty this, but having confusion because of LOTL when I marked the zone according to rule book. It is medium plus high probability, but can you please check? See, again, during these sessions, we are not getting into any symbol specific. I'm only looking into the examples which I'm sharing with you. Because like I said, these sessions are more inclined towards doing the analysis versus doing identifying trading opportunities, though these are trading opportunities, but I don't share the name of the symbols. But yes, we'll not be getting into symbol specific here. Okay, another great gem using the action grid. Can you use sideways market to go either long or short by being aggressive and being flexible when you get the absolutely. See, again, what we are trying to do is we are trying to have as much probability stacked in our favor as possible. So that is what this action grid is all about. But if you think about it, in sideways trend, if I'm planning a long trade, at least I'm not against the trend. If it is a downtrend, then I'm probably against the trend. I would like to be a little bit more careful, but sideways still acceptable. Like I said, as you have more and more experience, modifications can be done to the trade plan to make it better suit with your personality style. All right, so thank you for the explanation regarding my query on scaling out. Most welcome. What is the maximum loss you booked since you started in demand supply? So it's I have had cases where I had losses which were much bigger than what my trade plan allowed me to take. And the reason why it happened is, the reason where I always keep telling you that if you have a DIT trade, don't keep it as an overnight trade, because that was very, very long time back. I just started learning demand and supply. I took some DIT trades, which otherwise should have not been kept overnight. And what happened the very next day? The stock, it gapped down really, really huge and gave me a very big loss. But yes, it is a part of the parcel, and that is how you learn. And that is why, this is one of the rule which I always tell you people, that at least for HITs, DITs, don't keep them overnight, because that will be the main issue specifically for a bigger loss. Because when the markets are live, if it goes against you, you already have your stop loss to protect you. So the only time you'll have a very big loss is when it gaps against you, or maybe when you have reached your daily loss limit, but you're still taking the next trade, and the next trade getting into the revenge trading mode. That is also where you can have big losses. But again, as humans, I'll say we only learn it the hard way. So I have learned some of these things hard way. And trust me, even though I give you these things which you should be following, but I know many of you will still learn it the hard way, right? So that is how we are properly designed. Anyways, let's see what do we have next. I am making a point to review the recording sessions at least 2 more times after the live session to ensure I don't miss a golden nugget that will give me aha moment. Yes, so it definitely helps. But like I said, even if you're not going through the recordings again, every other week, I'm doing a new session for you. So you will still have a lot of things to get from those sessions as well. Okay, another fantastic live session. I'm thankful for you to making the course free and the live sessions for everyone. All right, perfect, great. So that brings us to the end of today's session. Thank you everyone for joining in. Next, I'll be seeing you next weekend. Till then, trade safe, enjoy your Sunday. Take care. Bye-bye.